Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in there. Let's take a look, see what people are sharing, and I'll share my financial opinions. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. That's where I dive deeper into all of these topics, sectors, looking for potential investment opportunities, sharing that with the community that's there. I also do a lot of trainings that people are asking for. The next training, which will happen next weekend, will be on portfolio position size, risk reward, and setups, and tying that all together, also with physical metals. And I'll talk about all of those things combined in that meeting. We just recently covered, if you guys want to know, my strategy and my approach to finding investments. And I used oil as an example and some of the logic and my thought patterns on how I approach things. If you're interested, you can join with the Black Friday, it's one word, Black Friday coupon code, get you a larger discount if you are interested. So the dividend dominator, he says the longer you wait to learn about investing, the greater the chance of working until you're 60. And if you become a deadly investor where you can buy bottoms, hold through different cycles, and then sell anywhere close to the top, I think you can beat basically everyone. Even the well-known investors, they are also beatable. And that has been my goal, is to beat as many people as possible to get those returns as high as possible, because your higher returns will compound your money even faster. And I do think there's a possibility to compound rapidly in short time frames given certain market conditions. It isn't possible all the time, but it is possible during certain periods with certain entry points. And they can drastically expedite the process of your returns so long that you know what you're doing. If you don't know what you're doing and you're taking on unnecessary risk, then it can obviously go in the opposite direction. Tyler says, I remember when I thought $100,000 was a lot of money. $100,000 is a lot of money. It still is. And what I would say is, I used to remember when I could go to the grocery store and get like $20 worth of stuff. And it was a good amount of stuff. Now $20 won't get you anything. That's like a package of beef or something. Like it doesn't get you anything. I walk out of stores and I am surprised if I get out under $200 out of Sam's Club or something. Now I am feeding a family versus just myself back in the day, but I will say I thought $100 was a lot of money back in the day, and now $100 is like, like most stores I go out of it's between 80 to 100 and something dollars almost in everything. If you just buy a couple of items, and it's like, oh my gosh, that's what I know. Captain Foresight says XLE is on the verge of hitting an all-time high, while XEG, which is the Canadian energy, lags badly. So, what are some things that we can discern here? Does that make XLE a better investment? No, it doesn't. So, I'll give you an example of some things that I look for. There are market leaders, and then there are companies that lag. It does not mean that a lagging company will underperform. It just means that it moves behind the leaders. Sometimes when you look at the leaders, it's the big boys, the Chevrons, the Exxons, and stuff like that. That's what makes up XLE, the big boys. Big money, big smart money, positions first in the big companies. So the big companies move first. Now, Canada, they don't have that many big companies in comparison to the Chevrons, the ExxonMobils, the ConocoPhillips, whatever else there is. So they might lag because the smart money isn't entering the companies in Canada. But it doesn't mean that Canadian energy companies will lag the performance of XLE. I think XEG will drastically outperform XLE. That's my opinion. And it deals with them being a higher cost production area. So oil needs to move more to the upside for them to really gain the leverage in their balance sheet. And just knowing that information gives you an advantage. Just knowing what I described right there. And I'm just scratching the tip of the information that I know about the oil sector. So when things are low and they come off their lows, when I say low, when oil price is low and it's flirting with the cost curves, the companies that are high cost producers are going to lag behind the low cost producers when they first get that hit up. Then, when the price goes far above the higher cost producers' break even points, that's the leverage that you get. So, the leverage of the higher cost producers are the things that will give you that extra return that you're looking for, that most people are looking for. But it is a little bit riskier because it may not go over that high cost producers' break even point. It's the things that you're trying to balance in terms of risk and reward. Coming up, unusual whales. It says Americans now consider 2.2 million the new minimum to feel wealthy per year. Do you agree with this? I don't think a dollar value is where I'm going to feel wealthy or not or comfortable. Wealthy is a mindset to some degree. It's not a dollar account value. Now, there is definitely a minimum amount, but I think it's all in relationship to what you owe or your cost of living expenses. So 2.2 million and you own a house, you don't have really that much expenses. So yeah, it's a lot of money. If you might even be good with like $1 million. So it all depends on your expenses. So, I mean, if you ask someone, is 2.2 million a lot in South Dakota? Yeah, it's a ton. Is 2.2 million a lot in New York? Probably not. So I think it's age dependent, it's location dependent, and it's dependent on your expenses. Here's something. The biggest thing that you can do if you really want to maximize everything is if you want to run uphill, you go to a high cost living state because then you have to make more money and then you pay more in tax. So they're going to take more as you make more. And that is both the state taxes and your federal income tax. If you want to run downhill, you want to go and make a lot of money in a low tax state with a low cost of living. So your expenses are incredibly low. If your expenses are low, then you don't need to save as much money. And on top of it, they take less from taxes. So the key here and the real metric that you want to see, and it's the same metric that you should use to evaluate companies. It is free cash flow per share. And really what it is income per expense. So what is your income divided by your expenses? And then that difference, it's a ratio, but that difference is your cushion or your margin. If you have incredibly low expenses, your income doesn't have to be as high. And if your income is lower, you get taxed less on a federal income tax. You probably will even get taxed less on your state taxes, and some states don't even have state income tax. So the difference between California and New York and Illinois and New Jersey is miles away from South Dakota, Tennessee, and Nevada, which has no state income tax and low expenses. So when you ask Americans to consider 2.2 million the new minimum to feel wealthy, that highly depends on your age, where you live, because that's where your expenses are. 2.2 million when someone owns their house and is in a low cost of living state is a ton of money. 2.2 million to someone in New York who doesn't own anything and pays rent with exorbitant rent prices is probably very little. Bitcoin dominance is dropping hard. Money is rotating to altcoins. No. What I'm going to tell you is that could be a leading indicator of where the altcoins might move next. Altcoins will probably peak later than Bitcoin, but Bitcoin is probably your leader. It's leading the group. Now, here's the thing. When I look at the Bitcoin chart, and he just shows that downward move. So if we pull up Bitcoin here, just to show you what it looks like real quick. And Bitcoin is here. When you look at Bitcoin, yeah, it still looks okay. It's not falling and rolling over, but this is probably your leader. And what they're doing is they're zooming in, and it does look a little bit roundish, topish. But guys, you need to know what leads. You need to know what lags. You need to know the firing order to some degree. This still looks good, in my opinion, on a daily candlestick basis. But be careful of all these people. They don't know what the heck they're doing. Okay, the Great Marty says, Jesus, this is very concerning. Sailor setting up the cattle for an absolute fleecing bloodbath. And you know, a lot of these people are making comments all in the short term. It's all on the short term. They think they can predict the market and predict the rollover. Now, is Bitcoin the legit? I don't know. I'm not in it because I don't want to be in it. But it doesn't mean people can't get rich off it. Sure. It's just not going to be me getting rich off Bitcoin. I'll get rich off something else. Stuff that I understand and stuff that I'm more comfortable putting large sums of money into. The dividend breeder says it took me 8 years to get to $100,000 invested. It took another 3.5 years to get to 200, and then 200 to 300,000. That took 9 months, and then you start to gain traction. Things really start to compound for you, and the better investor you are, the faster it can compound. The trick is to not blow up while you're compounding it. The trick is to not take too much risk. There's always going to be someone who makes money faster than you, quicker than you, just by sheer luck. And guess what? Most of those people lose that money too, because they were lucky. The trick is to get rich in a way that you can sustainably do it, where you're not taking horrible, drawdowns. It's a way that you can make money and you can replicate it over and over and over and compound it. It's not about getting lucky and getting absolutely wiped out every once in a while. Jesse Livermore is considered to be the best trader of all time. He died broke, and he went bankrupt multiple times throughout his investing life. Does that sound successful? To me, it sounds like he got lucky and he was gambling. But he got lucky and gambled a few times and did it multiple times. So one could kind of argue that maybe his risk reward was more of a gambler mindset. Now, what about other people? How can you reliably make money over long periods of time? And there are certain things that you can do, like buying value. You buy the price when it's below the value of the business. And then you can repeatedly do that, use a longer time frame, and repeatedly get good outcomes. So that's the strategy that I'm more closely adopted to or linked to. The gambler mindset, you're going to go broke. and they shove in all the chips all at once. Concentration and luck can get you rich very quickly, but you won't be able to replicate it over a long period of time, and your ups and downs will be tremendous. O'Hare says the funny thing about Bitcoin, the more time I spend studying it over the years, the more I'm convinced it's literally just the biggest Ponzi scheme in history so far. That's what I've come to the conclusion. The more I look at it, the more I think it's a Ponzi scheme. Correct. But that's me. And that's why I don't participate in it. I don't have to get rich off of what everyone else is getting rich off, so to speak. I can do my own thing, swing at the pitches that I like, and just pass on things that I think could be too risky or things that I might not understand completely. Captain Foresight says WCS, that's Western Canada Select, differential stands at minus $12.15. Potential to narrow further with BP Whiting Refinery coming back online. And a lot of people miss this. Sometimes WTI trades sideways, but the differential squeezes. So the Canadian companies actually are making more money, even though WTI that most people follow goes sideways, depending on what the Canadian company is tracking to. Some track more to WCS, others track more to WTI. Here's WTI. It says has demonstrated increasing strength throughout the week, starting with Monday's bullish engulfing candle at support, a key reversal signal indicating a shift in momentum. He's got that double bottom. So this is your potential double bottom. Here's one and here's potential two with the bullish engulfing on the right-hand side. That's usually how it sets up. Downtrend, 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 bottom one. Bottom two generally gets a bullish candlestick here or a big wick at the bottom with a slingshot pattern. And then we've broken the downtrend here. Looks really good. And he's talking about the double bottom pattern, 2 consecutive lows. Sometimes you get these big wicks at the bottom, and then you break out of the mid peak. We haven't done that yet. The mid peak's up here. So maybe that's the case. It does look good. And it says here, look for bullish engulfing candles at key support and after a downtrend signaling a potential reversal. And that's what I used on the daily market update, was that bullish engulfing. Yellow Bull says, so he's asking ChatGPT, it says, is it possible to adequately run a modern industrialized nation on an energy grid comprised of just solar, wind, and battery backup? And obviously it's a joke. It says, LOL, laugh out loud, or lots of laughs. No. Make AECO great again. AECO's the natural gas price, and you can see the big move from mid-November to where we are today. Big, big, big move. In fact, it's over 100% move in natural gas prices. What do you think that's going to do to the balance sheet of some of these companies where they might not be hedged? You know, they might have 50% unhedged or whatever they have unhedged. Plus 3 million barrels of oil equivalent per day by 2028. And it says, like trying to make rocks turn into gold. So Besant has advised Trump to pursue a 3-3-3 policy, cutting the budget deficit to 3% of gross domestic product by 2028, spurring GDP growth of 3% through deregulation, and producing an additional 3 million barrels of oil or its equivalent a day. So that's kind of what the goal is. JC says, former resistance and energy prices now turning into support. Do you see it? This is your old resistance areas is now our new support areas. And I do think that we will start working our way on up soon. Ryan says from 1980 to 2014, a JP Morgan study found that 40% of stocks lose money. 64% of stocks underperform. And only 7% of stocks accounted for nearly all of the gains. Only 7%. Now, how do we know what those 7% will be? I can tell you how I know. You can see them growing. You can literally see them growing. Did Google come out of nowhere? I mean, it did in the beginning, but that was a pretty easy bet. Apple, when they first came out with their iPhone, pretty easy bet. Chick-fil-A, which is private, if they went public, pretty easy bet. In-N-Out, same thing. Chipotle, I went and ate there. I'm like, dude, they're going to make a ton of money. This is by far better than McDonald's and all the other garbage. I just thought those things were easy. MasterCard, Visa. There's a Wells Fargo on every corner. Easy bets. So those are part of the 7%. The ones that are just easy. You can just see them everywhere. Where do you work? What are your options for health insurance? Go buy those health insurance companies. Easy bet. It's all over the place. Investment wisdom. Investing lies at the intersection of economics and psychology, the place where net present value meets greed and fear. And you need to take fear into account from psychology and take advantage of it. When others are fearful, that's when you're greedy. So Tavi says, if you think Trump, Vance, Bissett are going to let the dollar stay at these valuations, you got another thing coming. Obviously, Tavi says, well said. And what people are guessing is that we're going to get a weak dollar. A weak dollar is going to send commodities to the moon. It's going to send it to the moon. It's going to send precious metals to the moon and emerging markets. The stock market is a device for transferring money from the impatient to the patient. I'm going to keep saying this over and over, guys. Your advantage is being patient. And you know what most people can't do? Well, be patient. And that is your advantage, is being patient. The whole advantage is adopting a patient strategy to transfer money from the impatient to you. So you have to be patient, unfortunately, to have that strategy. No one wants to get rich slow. No one does, but that's how it works. And then it happens real fast. So we got Christine here. It says U.S. Shale doesn't have the assets left to scale plus 3 million barrels per day unless the price of oil was greater than $100 a barrel. And even if we did, we can't manage the additional 12 to 15 million barrels per day of associated water. Biden benefited from the drilled uncompleted wells under Trump. The well piggy bank of easy-to-scale barrels is now empty, and we are running out of cheap water disposable options. So here we go. This is going to be one heck of a problem when we try to ramp and scale U.S. anything, that we can't do it. So here's Z4 Energy Research. It says active frac count is down 21% year over year. And that's when you frack the wells. You get drilled uncompleted, and then you get the finishing, the fracking that comes later. And this is just showing how much lower we are with fracking. So we were eating through our inventories here, and then we declined when the price started to decline. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.